All right, let's set the stage. My client outsources payroll to a service organization, and as the auditor, I want to rely on that service org's controls so I can cut down on testing at the client level. The question is, which report actually gives me evidence about the operating effectiveness of those controls for the period? Statement 1 says a SOC 1 Type 1 report as of year end. That sounds official, but it only tells me about the design and implementation of controls at one point in time. It's like a yearbook photo, posed one-day evidence. It doesn't say whether the controls actually worked day after day. That's not enough for me to rely on. Statement 2 says a SOC 2 Type 1 report covering security and availability. Wrong focus and wrong type. SOC 2 is about trust services criteria, security, availability, confidentiality, things like that. Great if I'm auditing a cloud provider, but not if I'm trying to evaluate payroll for financial reporting. Plus, Type 1 again is just a snapshot. Statement 3 says a SOC 1 Type 2 report covering the relevant period. This is the winner. SOC 1 is about financial reporting controls, and Type 2 goes beyond design. It shows operating effectiveness tested over a period, usually 6 to 12 months. This is what standards like AUC 402 tell me I can actually use to reduce my testing at the user entity. So, which one is correct? It's the time-lapse video instead of a single selfie. Statement 4 says a bridge letter from management of the service organization. That's just management writing, "Don't worry, nothing changed since the SOC report ended." It helps fill the gap between the report date and year-end, but it's not independent evidence of operating effectiveness. It's like a sticky note from the service org. Helpful, but not the real deal. So, which one is correct? It's the SOC 1 Type 2 report covering the relevant period. That's the only report that gives me what I need: design plus operating effectiveness tied to internal control over financial reporting. Here's how I lock it in. Type 1 is a selfie, Type 2 is a time lapse, and a bridge letter is just, trust me, nothing changed. If I need evidence about operating effectiveness for the audit, I'm going with the time lapse, the SOC 1 Type 2. Final answer, option C. All right, let's slow this one down. The question is, which is the best planned response to potential non-compliance with laws and regulations that have a direct and material effect on the financial statements? Option A, send attorney letters to all vendors to confirm legal matters. That's way off the mark. Vendor confirmations are for payables or terms of business, not for legal exposure. When I need to look at legal issues, I send an attorney letter to the client's external legal counsel, not to vendors. So this option confuses the procedure. Option B, perform only inquiry of management because auditing standards prohibit further procedures. Nope. Standards don't say stop at inquiry. In fact, for laws and regulations with a direct and material effect, like tax laws or pension laws that impact financial statement amounts, I'm expected to go beyond inquiry. I need to design and perform audit procedures responsive to those risks. Inquiry alone is not enough, so this option is misleading. Option C, obtain an understanding of compliance framework, design procedures to test compliance, consider effect on financial statements. This is exactly what the standards say. Under AUC 250 or ISA 250, my responsibilities are: understand the applicable legal and regulatory framework relevant to the entity and industry, design procedures to identify instances of non-compliance when laws and regulations directly and materially affect the financial statements, evaluate the effect of any identified or suspected non-compliance on the financial statements and on my audit report. This matches word for word with the requirements. It's the gold standard response. Option D, rely on the internal control questionnaire without additional procedures. That's too shallow. A questionnaire might help me understand controls, but I can't stop there. If non-compliance could materially affect the financials, I have to perform procedures that actually test compliance. A questionnaire alone won't cut it. Correct answer, option C. Here's how I keep this straight in my head for the exam. If the law or regulation could directly change the numbers in the financial statements, like tax laws or revenue-related regulations, then I need to treat it like any other material risk. Understand the framework, test compliance, and evaluate the effect. If it's an indirect law, like workplace safety or environmental regulations, then inquiry and scanning minutes may be enough, unless I become aware of a violation that could materially affect the financials. So for direct and material laws, I roll up my sleeves and design procedures. For indirect laws, I start with inquiry and remain alert. All right, let me walk this out step by step. The fact pattern: new ERP system went live mid-year, access management is weak, and programmers can change code directly in production. That's a red flag. Weak IT general controls, ITGCs, around program change and access. Option A, assess control risk high for affected processes and increase substantive procedures, including tests closer to year-end. This makes sense. If ITGCs are weak, I can't place reliance on automated controls or system-generated reports. That means I assess control risk at the high end and compensate with more substantive procedures. Testing closer to year-end helps address the higher risk of misstatement. Option B, increase reliance on IT-dependent controls because automation is higher? That's backwards. Automation only helps me if controls are reliable. Here, access management is weak, so I can't increase reliance. Option C, rely on the prior system's controls for the full year because they were effective last year? Not acceptable. Once the new ERP went live, the prior system's controls don't cover the period anymore. I can't rely on them past the cutover date. Option D, use only inquiry since it is inefficient to test ITGCs? Inquiry alone is never enough to support reliance on controls. And here, testing ITGCs would show weaknesses anyway, so I can't stop at asking questions. So the most appropriate response is option A, assess control risk high and increase substantive procedures, including year-end testing. When I see weak access management and programmers can change code in production, I immediately think ITGC is unreliable, control risk high, beef up substantive work. Here's a clean recap you can drop straight into your reviewer notes. When ITGCs, IT general controls, are strong, I can rely on automated controls and IT-dependent reports. Control risk may be set lower, which means I can reduce some substantive testing. Testing strategy, focus on control testing plus some substantive procedures. When ITGCs are weak, automated controls and reports can't be trusted. Control risk is set high. I must increase substantive testing. More detailed tests, more samples, more work at year-end. I can't rely on prior system controls once a new ERP goes live mid-year. Exam shortcut in my head: strong ITGCs, rely on automation, less substantive work. Weak ITGCs, no reliance, more substantive work at year-end. Let me think this through carefully. The setup. Group materiality is $900,000. The group auditor sets different percentages for each component, 60% for component A, 40% for component B. The question is asking which statement about this is most appropriate. Option A, component materiality must be the same percentage for all components to ensure consistency. That's not correct. There's no requirement that component materiality be uniform. In fact, it usually varies because components differ in size and risk. Option B. Component materiality may not be less than performance materiality. That's a mix-up. Component materiality is about allocating tolerable misstatement across components, while performance materiality is set at the group and component level to reduce aggregation risk. There isn't a may not be less than rule like this. Option C. Component materiality must equal group materiality for each component. Definitely false. If I set $900,000 for every component, I'd ignore the fact that misstatements can accumulate across components. That would be reckless. Option D. Different component materiality levels are acceptable to reflect component size and risk. Yes, that's the right one. Group auditors adjust component materiality based on each component's relative financial significance and risk profile. It's normal for percentages to differ as long as the whole group is covered appropriately. Correct answer, option D. Here's how I keep it straight. Group materiality gets sliced up differently for each component. The slices don't have to match. They just have to fit the size and risk of each piece. The situation: management shortened useful lives for assets and changed the allowance model in a way that reduces bad debt expense. That smells like management bias in estimates. What should I do? Option A. Focus on controls only because estimates are full with substantive tests. That's not true. Estimates are auditable. I can test assumptions, methods, and outcomes with substantive procedures. Controls alone aren't enough. Option B. Increase materiality to reduce the number of estimates in scope. That would make the problem worse, not better. I don't raise the bar to ignore risky estimates. Option C. Assume estimates are reasonable because management knows the business best. That's the opposite of professional skepticism. I never just take management's word, especially when bias is possible. Option D. Design procedures to test methods, data, and significant assumptions. Compare to prior outcomes and involve a specialist if needed. That's exactly what standards AUC 540, ISA 540 require. For estimates, I test management's methods, data, and assumptions, look at historical accuracy, develop my own point estimates if needed, and bring in a specialist for complex models. So the right answer is option D. When I see management bias in estimates, my exam cue is test the methods, data, assumptions, compare to outcomes, and bring in help if needed. Never assume, never raise materiality, and never rely on controls alone. So the case: management is under pressure to meet loan covenants. Whenever I hear that, I immediately think incentive to manipulate earnings. The standards, AUC 240/ISA 240, tell me fraud risk factors include pressures to meet financial targets. The most common place this shows up: revenue recognition and manual journal entries. Option A. Send negative confirmations to all customers, regardless of balance. That sounds like, let's test receivables, which isn't a bad instinct, but the execution is wrong. Negative confirmations are weak. They basically say, customer, reply only if you disagree. If there's fraud risk, silence from a customer isn't persuasive evidence. On top of that, the standards say negative confirms are only appropriate when risk is low, population is large, and balances are small. That's not the case here. So this is not the right response. Option B, rely on analytical procedures only because they are efficient? No way. Efficiency is nice, but when there's fraud risk, I need effectiveness. Analytics can point me to unusual trends, but they don't dig deep enough on their own. Fraud risk equals more substantive detail testing, not less. Option C, add an element of unpredictability and focus additional procedures on revenue cutoff and manual journal entries. Yes, this is textbook fraud response. The standards say when fraud risk is identified, I need to add unpredictability so management can't anticipate my audit approach, focus on revenue cutoff. Are they recording December 31 sales that really shipped in January? Test manual journal entries because management override often happens there. This shows professional skepticism and directly addresses the incentive. Option D, reduce sample sizes because high fraud risk implies fewer items to test. This is backwards logic. More fraud risk equals more work, not less. I might increase sample sizes, extend my testing period, or bring in different types of procedures. Reducing testing would leave me blind where I need to see most clearly. So the clear winner is option C. Here's how I lock it in for exams. When I see loan covenant incentives, my brain translates it to heightened fraud risk. Then I remind myself, I can't lean only on weak evidence, so A and B are out. I don't reduce procedures, so D is out. I do inject unpredictability, scrutinize revenue cutoff, and dig into journal entries. That's option C every time. All right, let's break this one down carefully. We're in single audit territory, uniform guidance. The facts? Entity spent $950,000 of federal awards, all under one program. The program has a new compliance requirement. Exclude the program from scope because there's only one program. No way. If there's only one program, that program is the major program. I can't exclude it. Option B, rely solely on the financial statement audit because controls are similar. Nope. A single audit isn't just about the financials. It's about compliance with federal requirements. I can't skip compliance testing just because controls overlap. Option C, treat the program as low risk because expenditures were under $1 million. Not correct. The $750,000 threshold is the trigger for needing a single audit. Once I'm over that, I must test at least one major program. And new compliance requirements are a risk factor, not a reason to call it low risk. Option D, identify the program as a Type A program, potentially high risk, and plan compliance testing over direct and material requirements. Yes, since total expenditures exceed $750,000, a single audit is required. With only one program, that program must be tested. The fact that it has a new compliance requirement makes it potentially high risk, so I plan compliance testing of the direct and material requirements. Correct answer, option D. How I keep it straight for exams. If federal awards greater than $750,000, single audit required. If there's only one program, it must be tested. New compliance requirements equals higher risk, so can't call it low risk. Therefore, always plan compliance testing on that program. Here's the single audit planning checklist I'd keep in my notes. Next question. The auditor notes several round dollar journal entries posted late on the last business day to revenue and cost of sales. What is the best planned response? Option A, send confirmations to vendors only. Vendors aren't the issue here. This would be like checking your neighbor's fridge when you smell something burning in your own kitchen. Option B, decrease testing of manual entries to avoid duplicate procedures. That's upside down logic. When something looks suspicious, you don't test less. That's like hearing strange noises in your attic and deciding to stop looking up there. Option C, ignore them because round numbers are common at year-end. Sure, round numbers can happen, but when they all show up on the last day in revenue and COGS, that's not common. That's like your friend always picking 7 in a guessing game. Sooner or later, you know something's up. Option D, increase substantive testing of revenue cutoff and examine supporting documents for those entries. This is the right call. Those late, neat, round dollar entries are classic override red flags. Time to pull the receipts, check cutoff, and see if management was trying to pad the numbers. Correct answer, option D. When I see round last day entries, I remind myself, these aren't just tidy numbers. They might be management's doodles in the margins. Go test them. When I'm thinking about journal entry testing and fraud risk, a few red flags always jump out at me. Round dollar entries are one, because real business transactions rarely come out in perfect even numbers, and that makes me want to dig into the supporting documents. If I see a bunch of entries dumped in at period end, that's another classic warning sign, since management often tries to manipulate cutoff by pushing revenue forward or delaying expenses. Manual entries are a big deal too, because they bypass the system's automated controls. Whenever something is done manually, I select those entries and go deeper. And if the entries hit revenue or cost of sales, my guard goes up even higher, since those accounts directly affect profit and loan covenants. I also watch out for vague explanations. If the journal entry description says something like adjustment without details, that's not good enough. I'll push management for proper documentation. Finally, if the person posting the entry seems unusual, like a senior executive instead of accounting staff, that's another override red flag that deserves extra scrutiny. So my built-in response is test cutoff, trace entries to real source documents, and keep my professional skepticism sharp. Moving on to the next question. Management recently created several variable interest entities, VIEs, for supply arrangements. What is the best planning response? First, let's clear what a VIE is. A variable interest entity is a legal structure, often a partnership, trust, or company, where control isn't based on owning the majority of voting shares. Instead, control comes from contractual or other arrangements. VIEs are often used in supply, leasing, or financing arrangements. They can be legitimate, but they're also famous for hiding risk off the balance sheet if not properly consolidated or disclosed. Hello, Enron. That's why auditors treat them as high-risk areas, especially for related party transactions and unusual terms. Now the choices. Option A, rely on management's representation that all related parties are disclosed. That's not enough. Management reps are necessary, but they don't replace substantive audit procedures. Option B, exclude the entities because they're not consolidated. No, even if not consolidated, they may require disclosure. Ignoring them would miss potential misstatements. Option C, focus only on consolidation disclosures at the end of the audit. Too late and too narrow. VIEs affect not just disclosures, but also whether consolidation is required, and those risks must be addressed early. Option D, identify a significant risk related to related parties and unusual transactions. Plan procedures to understand the purpose, terms, and accounting. This is the right response. VIEs are inherently tied to related parties and unusual structures. Standards require me to treat them as a significant risk, understand their purpose and economic substance, and evaluate whether the accounting and disclosures are proper. Correct answer, option D. When I see VIs, I don't just trust management. I go into detective mode. What's the purpose? What are the terms? And is this being accounted for and disclosed properly? That's how I lock in option D. Moving on to the next question. The auditor assesses a significant risk for revenue recognition. Management uses a complex pricing engine with frequent manual overrides. Data flows from the web front end to the ERP via custom scripts. Which is the best planned response? All right, here we go. Revenue recognition is already the usual suspect in every audit crime movie. Now throw in a complex pricing engine, manual overrides, and custom scripts moving data around like back alley couriers? That's not just a red flag, that's fireworks. Option A, increase sample sizes for inventory only. That's like your house is on fire in the kitchen and you go water the garden. inventory isn't where the risk is. Option B, perform only cutoff testing at year end. Cutoff is good, but only doing that here is like checking just one tire on a car that's swerving all over the road. Not enough. Option C, test relevant automated controls and ITGCs, add unpredictability, perform detailed tests of manual overrides and interface reconciliations. Yes, finally some sense. If management is overriding prices and custom scripts are moving your data, you better test the IT controls. Check those overrides like a hawk, reconcile interfaces, and keep your audit play unpredictable so no one can script around you. Option D, send negative confirmations because they're faster. Sure, they're faster, but so is running away from the problem. And in fraud land, negative confirms are about as reliable as asking, shout if you don't have a problem. Correct answer? Option C. Whenever I see complex pricing, manual overrides, and custom scripts, I don't grab popcorn. I grab my ITGC checklist and prepare for a long night.